Hey everyone, this is Finding Value. Wanted to go over some ratios, the real estate ratio, so real estate to silver, real estate to gold. I want to go over hourly wages. I want to go over just touch on the S&P 500 again, and then the monetary base in relationship to gold. So I'm going to cover that real quick. Let's jump right in. So the first one is the real estate to silver ratio. We bottomed in 1980. That's when there was a peak in precious metals. We bottomed in 2011, which is a peak in precious metals. And I think the real estate market peaked in like the late 70s, mid 70s over here. We also had an expensive real estate that kind of peaked over here, but precious metals really took off. So we saw that ratio at a high point in terms of real estate could buy lots of precious metals. So this is telling us that we're getting into these peaky situations in real estate when the ratios are up here. Down below, we're getting into a peaky scenario for precious metals. And someone had asked, how do you know like what the top looks like in precious metals? Whenever you start seeing precious metals get valued expensive against a whole bunch of other either commodities or other assets in terms of S&P 500, in terms of real estate, in terms of other assets within the precious metals arena, that's when you know you're getting to a top. That's when you want to start transferring your ounces of either silver or gold or platinum to other assets. So that's one way to tell if there's a precious metals top. This is gold. Again, mid 70s, it was high. Real estate could purchase a lot of ounces of gold. It was low in 1980. That's a very fast and steep move. So gold really took off. And I think that's what's coming up is this type of move right here, coming up in the next 3, 4, 5, 6, 7 years. We've got a long drawn out move where gold lost lots of value against real estate. So this is a real estate top. Then precious metals gained to 2011 from early 2000. Makes sense. That was a precious metals boom. And I think this is going forward, gonna drop quite a bit down. So I think we're going to see precious metals outperform real estate here shortly. Next is production workers' hourly wages in gold. This is in grams. And I just want people to understand that this is declined. You know, now is 1/6 the value of 1971. 1/6 the value. That is how much the paper currency has lost in terms of gold in hourly wages. So hourly wages are obviously priced in dollars. When you price it in gold, it looks like an absolute abysmal stealing of wealth from hourly wages. Paper currency, that is. Next, this is in the S&P 500 in grams of gold. And if you notice, it's not the S&P 500 really hasn't gained and has held a substantial gain against gold. It's just going back and forth around a couple ounces of gold is typically what it gets priced around. We are overvalued. It is declining if you use new data. It's coming back down. So I have a feeling that we're going to end up somewhere down here back to like 1980 or lower. So I think that's what's going to happen going forward. This is the U.S. monetary base per capita versus gold. So basically what this is saying is that we could have went back to a gold standard in the 1980 era using this 100% monetary backed calculation. For that to happen again, we're going to have to go much higher. And I think these, granted this is a little bit old, this is 2019, it's probably more around 20,000-ish data for 100% or more. And the bottom probably moved up to like 8 or 9 grand or something like that. Because we've created a whole bunch of currency recently. So this usually accounts for it during the big bull markets. And I think we're going to shoot up here very soon over the next 5 years. And then the last one I have here is this is the gold to oil ratio and just how crazy it has gone recently. So it's kind of in that 10 to 30 range going over time. And then we shot way up to like 100 and something because, you know, oil went so cheap during that COVID shutdown. So another thing I'd like to talk about at the end here is we have to use ratios in order to understand relative value, to remove the dollar away. And the reason we remove the dollar is inflated, and we don't know, or we don't have a stable valuation of the dollar. So we could price things in dollars back, gold's, we'll call it currency, but when it was money and backed by gold. We could price everything in dollars because it was backed by gold, and you could redeem it for gold. So you could price it in dollars and you would hold your value because it's all relative to the gold backing. Now, since we lost that gold backing, you can't price anything in dollars because of the inflation and how inflation gets distributed amongst all of the assets, because all of the assets are going to go higher in price, but they're going to lose against each other in relative value. And that's where we're trying to extract is that relative value against different assets. So we want to ride the cheap asset, ride it up to expensive against other assets so we can get that purchasing power gains. I just wanted to share these with everybody. Hopefully they have some value and some entertainment. This is Finding Value. Appreciate you guys listening. Please click subscribe and comment below. Thank you.